News you can trust.
Saul Albom, Market News First. Thanks so much for joining us. You are in the micro cap engine, and this is the only place of which you want to be. And they're giving you a desk shot. Just shows you how much. Shows you the command center we got here. We got the laptop. We got the keyboard for the computer up there, and we have the computer over on the side here, which I can show you the stocks of which we talk about, the level 2s. And I'm quite excited today. We have an action-packed day here in the Microcap Engine. First, we're going to have an economics report by Gary Dorsch, the editor of the Global Money Trends newsletter. Then we're going to have Scott Massey and Stephen Bowen up on the line. They're going to be talking about their companies and how they are going to, well, basically help revolutionize, well, pulling oil out of the ground. So I'm quite excited. Again, we have Scott Massey with ticker symbol DYNI, Dynamic Natural Resources. Then scheduled up at 11:30, we have Nick Milano, and he is with Americos, and they do bioremediation. So I'm quite excited to have them on. It's very important you cover all this stuff. So we got the oil, and we got the remediation, and that is ticker symbol AEGX at the bottom of the hour. So we have, and then we have microcap news. So let me go ahead and pull up. This is our Gary Dorsch here. Gary, this is Saul Albom, Market News First. How you doing, sir?
Having a good day, Saul. Glad to be with you.
So, so we have a lot of changes going on, and what interesting times we are living in. Gold making moves, Saudi Arabia, rumors with Saudi Arabia. We have parity with the with the Canadian dollar. We have, oh my goodness, just so much. We have B-52 Bernanke dropping lots of money all over the place. Gary, you want to start with Saudi Arabia?
Sure, we can start there. B-52 Bernanke did come in today and injected $29 billion into the U.S. banking system, and eventually those dollars will start to weigh on the value of the dollar, and is leading to quite a run this morning with the euro at $1.41, the Canadian dollar at a 31-year high, trading at $1 to the dollar. That had been as low as 60 cents a couple of years ago. And there's a lot of countries in the world that try to keep their currencies pegged to the dollar, such as the Hong Kong dollar and the Saudi Arabian rial as two examples. And these countries in the Persian Gulf, actually there's 5 Arab oil kingdoms who collectively control about $1.6 trillion in foreign markets, have their currencies pegged to the U.S. dollar. And if the Federal Reserve is printing a massive amount of money like Mr. Bernanke is doing right now, I think he's printed over $300 billion in the last 5 or 6 weeks that he's injected into the market. Some of that is withdrawn from the market. It's not a total permanent injection, but a lot of that money has not been withdrawn and remains in the system. And it forces countries like Saudi Arabia to print money of Saudi Arabian rials just to keep equilibrium with the dollar. And we are seeing that also occurring in other countries in the Persian Gulf, such as the United Arab Emirates and Kuwait, where their money supplies are growing at 20% a year in trying to keep their currency stable against the dollar, while Mr. Bernanke is printing U.S. dollars at a rate of 14% a year. So we have these competitive printing competitions going on, and it's all leading to a lot of inflation in the Persian Gulf. About 12% inflation rate in Qatar, for instance. So these countries are saying, look, we can't keep printing so much currency just to maintain this dollar peg. It's creating too much inflation at home. The population's getting a little restless. So we may have to print a little less money.
That's funny, Gary, because most countries have the idea of the peg in order to stabilize their currency, and now it's working in reverse. Now it's hurting them.
Well, when the Federal Reserve gets so out of control like it is now, it makes it very difficult to maintain these pegs. You know, when Mr. Bernanke took over a year and a half ago, the money supply was growing at an 8% rate. Now it's growing at 14%, And at the rate of injections and interest rate cuts that he's projecting, we could see the U.S. money supply growing at a 16 to 18% rate in the next few months. And if that was to occur, other countries would have to ramp up their printing presses to prevent their currencies from rising. And we would just see massive money printing going on around the world. And this may sound a little fanatical. I don't try to be fanatical. I try to be simply objective and see how, call things as I see it. But this is extraordinary circumstances that I haven't seen in my 27 years of watching and analyzing the market and in trading. So if Saudi Arabia decides that they can no longer keep their printing presses going at the rate they're going, they may have to devalue the dollar, let their currency go up so they don't have to print so much money. And if they unhinge the dollar peg, that could have a major psychological blow to the dollar where it could collapse and lead to much higher inflation in the United States and around the world where a lot of commodities are linked to the dollar. So, for instance, crude oil is at $82, and one major reason oil is so high is because the dollar is so weak. So Mr. Bernanke, in cutting interest rates and flooding the world with dollars, could actually lead to sharply higher oil prices and higher inflation. This is a mad scientist at work right now, and I don't quite understand what he's doing unless he has information that the subprime debt crisis could be much greater than anyone could imagine. There's over $1 trillion of this debt that may be worth very little. It could lead to massive losses for a lot of banks, and so perhaps he's just trying to cover it over with papering the system. But it's going to lead to a lot of inflation, and it's important for investors to understand this so that they can protect themselves.
Again, we're speaking with Gary Dorsch, the editor of the Global Money Trends newsletter. You can find his newsletter at globalmoneytrends.com. Gary, do you think that maybe they were afraid of the runs on the banks that England was experiencing?
Well, that was a possibility, but the Bank of England and the UK Treasury guaranteed depositors that they would get all their money, and that seemed to calm things down. And now the Bank of England has done a U-turn and has injected £10 billion into the British money markets overnight to help push down short-term British interest rates. And there's another money injection going on in England. So all this money injection to contain this subprime crisis is leading to money printing, and gold has not had such a wonderful background like this in many, many years. And the gold price right now is at $736 an ounce. It took out the high of $730 that we hit last May in 2006, so it's now at a 28-year high. And really the next target would be the all-time high of $830 if this run continues. And I've been writing a lot about the gold market in my newsletter and making projections. I do have projections in mind that I have informed my subscribers about. And I'm also going to be presenting a model portfolio of 16 stocks that should do well if these trends continue. And they'll be posted in this Friday's September 21st edition and in subsequent editions. So I'd recommend that people go to globalmoneytrends.com or search chartsalot.com and sign up for the newsletter and get a look at